6-year-long career on Wall Street, advising investment banks and leading global transformation portfolios, upwards of $300 million, I took a step back and served as a board director for several global nonprofits focused on building communities for women, finance, climate, and technology. I also advise the boards and CEOs at growth stage startups in the US in product engineering, digital transformation, fundraising risks, and market expansion. My unique corporate, nonprofit, and startup leadership experience brings a differentiated and inclusive approach to fundraising with an impact priority for the planet and people while balancing profits. So I recently launched my own advisory business called Bhuva's Impact Global, in short, BIG, with an ambition to drive big transformations in the FinTech and sustainability sectors. I work with late-stage startups that are fundraising Series A and beyond as a fractional COO, that is, as a Chief Operating Officer in a fractional capacity. And I strategically advise the CEOs and board directors in 3 areas. Number 1, risk governance. This is where I help the companies to implement comprehensive risk management frameworks and to proactively mitigate financial, operational, and global market risks. Number 2, digital transformation, where I spearhead product innovation within the ethical AI boundaries, especially responsible use of artificial intelligence without compromising scale and agility. Number 3, ESG sustainability. This is where I provide oversight to integrate ESG regulations, that's environmental, social, and governance specific initiatives, into the overall business strategy and vision. As you know, I'm very passionate about financial inclusion, especially for women and women-led startups, and likewise equally committed to solving the climate crisis in our generation for underrepresented communities. So there's a need for people like me with leadership experience to guide our future CEOs. Impact and innovation are 2 pillars guiding me across my own diverse career pathways, and I'm continuously energized every time with financial inclusion and climate sustainability, similar to multinational corporations like Mastercard. Mastercard has actively incorporated sustainability into its business model, focusing on environmental, social, and governance principles. It also founded the Priceless Planet Coalition, a platform uniting businesses and consumers to fight climate change. It aims to plant 100 million trees over 5 years as part of its reforestation efforts. Part of sustainability for Mastercard also includes social sustainability, such as promoting financial inclusion. They aim to bring a total of 1 billion people and 50 million small businesses into the digital economy by 2025. The new SEC rule for climate disclosures, which mandates public companies to provide detailed reporting on their greenhouse gas emissions, climate-related risks, and their overall impact on the climate, presents both opportunities and challenges for companies like Mastercard. As a leader in sustainable practices within the financial sector, Mastercard can leverage these detailed disclosures to differentiate itself from competitors, potentially attracting more sustainably minded investors and customers. On the other hand, collecting and managing required data, particularly Scope 3 emissions, which include emissions from indirect activities such as business travel and employee commuting, can be challenging and may require enhanced tracking and reporting mechanisms. As a large corporation focused on finance and society, Mastercard is a leader in global payment solutions and facilitates scaling millions of transactions daily across the world. Mastercard has been at the forefront of innovative technology advancements in the payment solutions sector and has continuously shaped how consumers and businesses use financial transactions. Mastercard enables seamless, secure, and efficient electronic payment solutions and promotes cashless transactions while fostering the growth of the digital economy with a push for transformation. Mastercard has positioned itself as a leader in promoting financial inclusion, focusing on expanding access to financial services for underserved and unbanked populations around the world. The Global Inclusive Growth Partnership, including Aspen Institute and Mastercard, is working to create a financial system that includes everyone with help from global leaders and thinkers. In 2020, Mastercard pledged to bring 1 billion people and 50 million small businesses into the digital economy by 2025. This commitment includes a focus on providing 25 million women entrepreneurs with solutions that can help them grow their businesses. Also, the Mastercard Impact Fund, founded in 2018 with more than 20 million in grants to 172 organizations, has enabled 5.5 million people and 25 million small businesses in 97 countries to access financial services and other resources. Mastercard has been at the forefront of integrating advanced technologies, including generative AI, to enhance financial security and improve the overall user experience. Generative AI, which can create content or generate data patterns by itself, has several applications in the financial sector. With Decision Intelligence Program, a real-time decisioning solution, Mastercard helps banks score and safely approve 143 billion transactions a year. Decision Intelligence Pro, which could sometime be this year released, has AI enhancements that boost fraud detection rates on average by 20% and as high as 300% in some instances. While the benefits are significant, the use of generative AI in financial security does not come without challenges like bias, fairness, privacy issues, reliability, and transparency. Mastercard's corporate governance structure plays a critical role in promoting sustainability within the company. Effective governance ensures that sustainability is integrated into strategic decision-making processes and reflects the company's commitment to social and environmental responsibility. Sustainability-related risks, including those linked to climate change, regulatory changes, and reputational risks, are overseen at the board level at Mastercard through a risk management committee. Mastercard follows global standards for sustainability reporting, such as the Global Reporting Initiative, GRI, or the Sustainability Accounting Standards Board Guidelines, SASB Guidelines. Mastercard integrates sustainability into its core corporate strategy, ensuring that it's not treated as an isolated issue. This holistic approach is reflected in how sustainability objectives are woven into business development, innovation, and operational practices. Mastercard has robust board policies, such as 12 of 13 directors are independent and have sustainability experience, and thus encouraging ethical and transparent management, building trust with stakeholders. 33% of Mastercard's independent directors identify as female, 67% identify as diverse, and the stakeholders have the right to call special meetings at certain thresholds. Mastercard's governance structure effectively promotes sustainability by ensuring that it is a board-level priority while being deeply integrated into day-to-day operations and strategy planning. This approach not only helps in mitigating risks but also leverages opportunities related to sustainability, positioning Mastercard as the responsible leader in the financial sector. Regular engagement with stakeholders allows the company to gather insights and feedback on its sustainability practices, which can inform strategic decisions and help align its objectives with stakeholder expectations. Now, diving deep into the latest SEC rule, that's the Securities and Exchange Commission, introduced standardization of climate-related disclosures by public companies on March 6, 2024. This is to address investor demands for consistent information on climate risks and their management while considering cost implications. Firstly, public companies are mandated to disclose any climate-related goals or targets that have or may impact business operations or financial conditions, and the financial implications of these goals. Secondly, how is the board and management overseeing and managing climate-related risks, and how they are integrated into the overall risk management processes? And lastly, what are the costs and losses incurred from severe weather events and conditions, as well as those related to carbon offsets and renewable energy credits, if these are a significant part of their climate goals. To continue on the opportunities and challenges for Mastercard in light of this new SEC rule that I elaborated earlier in today's talk, as an example, Mastercard's push for digital transactions reduces the need for physical cash production. This initiative aligns with its climate-related goal of reducing carbon emissions associated with manufacturing and transporting physical currency. Yet, the digital infrastructure and servers that support electronic transactions also consume energy and could contribute to greenhouse gas emissions. Therefore, Mastercard would need to disclose this potential impact on climate change as part of their sustainability goals and initiatives to the SEC going forward. Regulations serve as both an incentive and a catalyst for businesses to work harder towards sustainability and responsible business practices. The requirement to disclose climate-related risks and mitigation efforts may encourage Mastercard to be more proactive and innovative in managing these issues, thus enhancing their existing sustainability efforts and to show their commitment to responsible business practices. The disclosure of board and management oversight of climate-related risks can highlight Mastercard's robust governance structure and demonstrate its effectiveness in managing environmental impacts. This SEC mandate to disclose climate-related goals and their financial implications could incentivize Mastercard to incorporate sustainability goals into their business strategy more explicitly. To summarize, as a board director and fractional COO, I strategically advise the executive board and the CEOs of a business in 3 areas. Number 1 is risk governance, where I advise about proactively mitigating financial, operational, and global market risks. Number 2 is digital transformation, for responsible use of artificial intelligence without compromising scale and agility. And number 3 is ESG sustainability. I want to solve the climate crisis in our generation for women-inclusive businesses. I have managed risks and led large-scale transformations before the 2008 global financial crisis and ensured compliance and sustainability for the same Wall Street investment banks and capital market institutions based on new SEC rules that were put in place to avoid another crisis. However, we had a repeat of the same with the Silicon Valley Bank crisis just a couple of years back, and this time it was impacting startups. While my advice has been consistent to proactively manage financial risks. If you are hosting a talk or seminar on the topics of risk management, financial inclusion, and sustainability on boards, visit my website to book me as a speaker. If you're a startup aiming to expand into the US market and want to connect with prioritizing impact and innovation like Mastercard, in the financial sector, download my latest free digital resource, the Essential Tech Startup Guide for expanding into the US market. Visit my website to download.